Let's begin with the market, though, as stocks do face more downward pressure today. Joining us now is BD8 Capital Partners CIO Barbara Duran and 248 Ventures Chief Strategist and CNBC contributor Lindsey Bell. Good afternoon to you both. Lindsey, you're here on set with me. Let's kick it off. It does seem like the easier, softer way for stocks right now is lower.
Yeah, I think this is day 10 out of 12 that the market's been down. So, yeah, there's a downtrend that we're in. We're also in a seasonally weak period of the year. We've contended with a couple different things. The banks got downgraded, a sovereign debt got downgraded, and we're getting through the end of earnings season. And so there's not a lot to hold on to. And really, I think that it's rates that really, truly is in the driver's seat. And we saw that again today with the release of the Fed minutes.
Yeah, Barbara, I want to get your thoughts on this because certainly we saw a big move for the first half of the year for stocks, particularly anything tech or AI related. So are we due for some seasonality and due for some consolidation here?
Yeah, I agree with Lindsey. I mean, it's really after a big run up in both NASDAQ and the S&P. This is, to me, a garden variety pullback. As she mentioned, earnings are done. The catalysts, we had news out of Japan in terms of taking the hard cap off their 10-year. And then there's worries what that does to our long end. And we are seeing a little bit of an increase there. You had the Fitch downgrade, Moody's, in terms of the banks. So there was a lot going on. So I think this is not going to be a deep correction. I think 3 to 5%. And we're probably pretty much there. And people are always cautious and all the worries come up. But I think this is going to prove to be a good buying opportunity because what's going on in the economy. You saw the retail numbers yesterday. You saw industrial production. Retail was up almost twice as expected. Industrial production was up almost 3 times. And so that portends well in terms of economic growth and earnings next year, which, of course, is what the market feeds off of.
Yeah, and it's such a key point, Lindsey. And, the S&P finished today down another 0.7%, 44.07. We're now down about 4% month to date for the S&P. But in that time period, we have seen yields on the 10-year Treasury, for example, climb back to and start testing the October highs. Mm-hmm. Where do we go from here? And I guess how are you thinking about the moves in the bond market and what that means longer term?
Well, when I look at the bond market, it certainly has obviously thrown investors kind of off their footing, and especially the tech trade, right, has come off because the interest rate's moving higher. But when I see that, to me, it tells me that economic growth is probably improving. And we saw it. Barbara called out a lot of the economic data that we got just this week. But it also says that with economic growth continuing, there's the possibility, like we heard from the Fed, that inflation can continue to move higher. And while the CPI is in a downtrend, it seems like there's some steam coming off the downward move in CPI. We have import prices increasing. We've got real wages increasing for 2 months in a row now. So there are some signs. You've got energy and food costs potentially continuing to rise. There are some signs that inflation can be sticky, maybe potentially perk up a little bit in the months ahead. You have easier comparisons that are coming across the board, too. So we'll see how much those tougher comparisons mattered over the last couple months and where inflation goes from here. And I think it probably makes sense for the Fed to make a couple moves from here, maybe 1 or 2 more hikes like we heard from in the minutes here. And you know what? I think the market and the economy can handle that at this point in time.
Yeah. Barbara, we certainly got those Fed minutes, and not too much in terms of a surprise, as is usually the case, from those minutes. But you mentioned the retail earnings, and TJX was one of the best performers in the S&P today. It finished up 4%. Speaks to the fact that you're seeing those results hold up better than expectations out there. Read through to some of the other names that we're going to get this week, like Walmart tomorrow.
Well, I think TJX has some special circumstances for it. It also has a very different mix than Walmart. I mean, what TJX saw was softness in clothing and home decor. But then we saw other companies like a Home Depot or a Target who had strength in their home decor. So I think Walmart has probably almost 60% in groceries versus TJX's 20%. So I think Walmart's going to be very different. I think their same store sales are expected to be 4%. And by the way, it is a core holding for me versus TJX, which was down 5.3%, worse than expected. So I think Walmart is going to report good earnings. And plus, they are truly omnichannel. They are killing it. They're gaining share, and they're even doing some innovative things with advertising. So I expect the numbers to be very good tomorrow.